The financial markets are currently closed, so let us look directly at the definitive closing figures for Datavault Inc., trading under the ticker symbol DVLT on the Nasdaq exchange. As of the final bell on Monday, June 29, 2026 at 4 p.m. Eastern Time, the stock finished normal trading hours at exactly $0.325 per share. This represents an intraday decline of 2.75%, down about 1 penny from its previous baseline. During the subsequent after-hours session, we saw a minor tick upward, pushing the price to roughly $0.33, but the core reality remains that this asset is trading deeply in the penny stock territory. While most retail traders glance at a 32-cent stock and dismiss it as a failing enterprise on life support, the underlying microstructure reveals a completely unexpected narrative. This asset is not just drifting, it is undergoing a massive, deliberate balance sheet restructuring that has institutional players quietly reallocating capital. While casual observers on mainstream retail platforms are busy looking for quick momentum swings, the firm recently announced a massive $60 million registered direct offering of common shares specifically designed to fund its asset architecture. This creates a fascinating structural setup where the public perception of an unraveling microcap stands in sharp contrast to a fully funded corporate overhaul. To understand why this gap exists, we have to look at how the average participant approaches self-investing nowadays. If you open up standard retail interfaces like the Robinhood app or look at trending discussions on modern investing sites, the massive retail crowd is almost entirely fixed on mega-cap options. People are constantly analyzing how to position their cash into standard heavyweights like Tesla stock, Apple stock, or Nvidia stock. When they think about building a long-term portfolio, they lean heavily toward automation tools like Schwab Intelligent Portfolios or traditional powerhouses like Fidelity Investments to handle their capital. The standard narrative says that you stick to predictable giants within an individual brokerage account to avoid catastrophic volatility. But the reality of specialized microcaps like Datavault Inc. forces a completely different analytical framework. The general consensus surrounding this ticker is heavily influenced by its past identity, since many veteran market participants still recognize it from its previous operating model as WISA Technologies, Inc. The common assumption was that the business was permanently trapped in a low-margin hardware licensing loop, struggling to maintain its listing requirements on major exchanges. This negative expectation caused a massive multi-year sell-off, dragging the equity down from its 52-week high of $4.10 all the way towards its recent cyclical floor of $0.2512. When you look deeper into the structural mechanics, you notice that the company is executing a total pivot away from standard consumer electronics licensing into high-margin infrastructure. They are systematically building out a decentralized network aimed at edge computing and localized processor systems. This is exactly where expectation and reality collide. While the crowd treats the stock as a dying legacy hardware business, management is leveraging capital markets to transition into an enterprise tech model. This mismatch creates intense tension in the daily trading volumes, which recently registered at 13.56 million shares against a historical daily average volume of 22.43 million shares. This compressed volume indicates that retail capitulation has already occurred, leaving a clean slate for institutional positioning. For anyone navigating online investing without professional guidance, handling an asset like this requires institutional-grade execution tools. Sophisticated traders who manage their own individual brokerage accounts tend to bypass simplified interfaces and instead rely on complex systems like the Interactive Brokers platform. Utilizing an Interactive Brokers account allows professionals to inspect short interest, evaluate order routing, and analyze deep book liquidity that ordinary retail platforms simply hide. When you look at the equity through that lens, you can see that institutional holdings like the Vanguard Group still maintain a baseline stake of about 1.38%. They're not treating this as a lottery ticket, they're holding it as a highly speculative, asymmetric option on decentralized edge infrastructure. To properly evaluate the near-term prospects, we need to dissect the recent financial changes that have impacted the equity structure. Just days ago, the corporation aggressively issued warrants to strengthen its capital markets position. This move, dilutionary in the short term, is exactly what drove the stock down to its current $0.325 level, as short-term traders reacted negatively to the expanding share count. However, the long-term reality is that this capital injection has essentially cleared out the immediate bankruptcy risk that was choking the valuation. By securing these funds, the firm now has the runway to deploy its edge node software without the constant threat of a sudden liquidity crunch. This brings us to a fundamental lesson about online investment strategies. Many individuals who engage in self-investing fall into the trap of buying into a business after it is already run up thousands of %. They see the massive gains of primary technology stocks on their Robinhood stock trading dashboards and think they can replicate that success by chasing standard momentum. True value, however, is often found in the unglamorous, beat-up corners of the market where businesses are actively shedding their old skins. Datavault AI is currently in that exact painful intermediate phase. Its reported earnings per share stands at a loss of roughly $0.96, a figure that scares away anyone using basic screening tools on popular investing sites. Let us pause for a moment to gauge the community sentiment on this specific operational shift. Comment below how many shares of Datavault AI you currently hold in your portfolio, or share your thoughts on whether you believe this transition into edge computing will successfully save the company from delisting. Looking back at the historical performance of the enterprise, the old business model was fundamentally flawed due to its reliance on consumer audio hardware integration. As WISA Technologies, the company spent millions of dollars in research and development expenses, which reached $5.73 million in their recent quarterly reports, while general and administrative expenses surged to $25.33 million. They were spending vast amounts of capital to support a wireless audio framework that faced intense competition from larger, vertically integrated technology conglomerates. The revenue generation was simply too small and unpredictable to cover the massive overhead, leading to an operating margin that sat deeply in negative territory at -97.93% for the trailing fiscal periods. The new business model completely abandons that expensive localized hardware approach. Instead, Datavault AI is focusing on licensing artificial intelligence-driven agents and deploying a quantum-ready graphics processing network at the edge. By moving away from direct consumer electronics and shifting towards enterprise software licensing, the company is attempting to dramatically reduce its cost of goods sold, which recently hovered around $3.30 million against total quarterly revenues of 3.42 million shares. If they can successfully transition their legacy customers over to this new software ecosystem, the gross margins should theoretically expand rapidly, creating a clear path towards operational sustainability. Investors who utilize full-service frameworks like Fidelity Wealth Management or automated portfolios often miss out on these micro-cap, microstructural shifts because their default settings filter out any equity trading under $5. Even those who build their own portfolios using Fidelity mutual funds or specific Fidelity ETFs are generally insulated from this level of volatility. But for the independent investor using specialized accounts like SoFi Invest or managing a dedicated active trading subaccount, these structural setups offer a masterclass in market psychology. The price action is entirely driven by capital market updates rather than standard macroeconomic data. When you analyze the future outlook for this company, there are two distinct scenarios that could unfold over the next 12 months. The optimistic case relies entirely on the rapid deployment of their edge network using the $60 million they just secured through their direct offering. If management can prove commercial viability and secure contract wins with mid-tier enterprise clients, the stock could experience an aggressive re-rating. Wall Street analysts from firms like Maxim Group have maintained a highly speculative buy rating with a target price of $3, reflecting the massive upside potential potential if the reality of the business execution matches the loftiest expectations of the executive team. Conversely, the risk profile here is exceptionally high, and any sober analysis must acknowledge the downside factors. If the company continues to burn cash at its historical rate without showing clear revenue acceleration from its new AI segments, the current $0.325 price point could give way to further dilution. The firm has a history of utilizing capital markets as a funding mechanism, and if they are forced to issue more warrants or execute a reverse stock split to maintain their NASDAQ listing, retail shareholders using standard accounts on the Robinhood mobile app could face severe capital impairment. This is the brutal reality of microcap investing. The line between a successful corporate turnaround and complete capital destruction is razor thin. As you look to position your own capital